It's July 4th, 1776. No fireworks yet, just a room full of revolutionaries signing their names to treason. But here's what most people never learned in school. This wasn't only a political revolution, it was a monetary one too, because more than 100 years before the Declaration was ever written, colonists had already committed their first act of financial defiance against an empire. So what did money have to do with liberty? And what happened to that vision over the next 250 years? Hello, and welcome back to Crest Finance. If you're joining us today, thank you for spending a few minutes of your holiday with us. It means a great deal. Before we begin, we'd love to know, where are you watching from today, and how are you celebrating the 4th this year? If you find value in stories like this one, consider subscribing to Crest Finance so you never miss an episode. Every year, millions of Americans watch fireworks light up the sky on July 4th. They wave flags, sing songs, and celebrate the birth of a nation. But few people ever stop to ask a simple question. What did freedom actually mean to the people who fought for it? For many of the founding generation, freedom was not just about politics. It was about money, too. The story begins long before 1776. In 1652, a small colony called Massachusetts Bay made a bold decision. They started minting their own silver coin, known as the pine tree shilling. This was a quiet but powerful act. At that time, only coins approved by the king were allowed to carry authority. Every coin was supposed to show the face of the monarch, but the pine tree shilling broke that rule. It carried no king, no crown, no royal symbol at all. Instead, it simply showed a tree. This might seem like a small detail today, but back then it was a direct challenge to royal power. The colonists were saying in their own quiet way that they could create value without needing permission from an empire. Historians often point to this coin as one of the earliest signs of independent thinking in America. It happened more than 100 years before the Declaration of Independence was ever written. As the years passed, tension between the colonies and the British Empire continued to grow. Taxes increased, trade rules became stricter, and the colonists grew more frustrated with a government that controlled their lives from thousands of miles away. Boston, Massachusetts, became a center of resistance. Groups like the Sons of Liberty organized protests and pushed back against unfair laws. This resistance eventually helped spark the American Revolution. When war broke out, the Continental Congress needed a way to pay for it. They could not simply print gold or silver, so they issued paper money known as continental currency. At first, this paper money helped fund the war effort. But it did not take long for serious problems to appear. The British government took advantage of the situation. They printed large amounts of fake continental currency and spread it through the colonies. This flooded the system with worthless paper and caused the value of the real currency to crash. The consequences were severe. Soldiers were sometimes paid in currency that was almost worthless by the time they could spend it. Farmers and merchants struggled to trust paper money at all. A well-known phrase from that era, "not worth a continental," became a symbol of how badly the paper currency had failed. The punishment for counterfeiting during this period was extremely harsh. In many cases, it was death. This shows just how seriously the young nation treated the crisis of trust in its money. This painful experience left a lasting impression on the founding generation. They learned firsthand what happens when money is based only on promises and government paper, rather than something with real, lasting value. Gold and silver, by contrast, did not depend on trust in a government or an army. They had value on their own, everywhere, at any time. This lesson would later shape one of the most important decisions the founders made when writing the United States Constitution. But that story comes a little later. For now, it is important to understand this simple truth. Long before the Declaration of Independence was signed, Americans were already learning about the dangers of unstable money. The fight for political freedom and the fight for sound money were closely connected from the very beginning. After the hardship of the Revolutionary War, the founders of the United States wanted to make sure the country never faced another currency crisis, like the one caused by continental paper money. They remembered how quickly trust in paper money had collapsed. So when they sat down to write the Constitution, they made a clear and deliberate choice about money. Inside Article 1, Section 10 of the United States Constitution, the founders wrote that no state shall make anything but gold and silver coin a legal tender for the payment of debts. This was not a small detail buried in the document. It was a direct response to what they had lived through. They wanted a system where money held real, lasting value, not one built purely on government promises. For many decades, this vision shaped the American monetary system. The United States Mint, created through the Mint Act of 1792, began producing coins made of gold, silver, and copper. These were not symbolic objects. They were used every day by ordinary people to buy food, clothing, and goods. A gold coin was worth its weight, no matter who was in political power at the time. However, over time, the country slowly moved away from this original standard. The shift did not happen overnight. It happened gradually, through a series of policy changes across many decades. Then, in August of 1971, a major turning point occurred. President Richard Nixon announced that the United States would no longer allow other countries to exchange U.S. dollars for gold. This decision is often referred to today as closing the gold window. From that moment forward, the U.S. dollar was no longer backed by any physical amount of gold. It became what is known as a fiat currency, meaning its value comes purely from government decree and public trust, not from a physical asset. This change had a lasting impact that continues to affect Americans today. Since 1971, the dollar has lost a significant portion of its purchasing power. Some financial researchers estimate the dollar has lost more than 98% of its value since 1913, the year the Federal Reserve was established. In simple terms, something that cost $1 many decades ago would cost dramatically more today, not because the item became more valuable, but because the dollar itself became weaker. Meanwhile, gold and silver have continued to behave very differently. An ounce of gold today is still an ounce of gold. It does not depend on interest rate decisions, government policy, or central bank actions. It simply exists as a physical, limited resource with real-world value. This is often referred to as intrinsic value, meaning the value comes from the material itself, not from a government's promise. In recent years, this old debate has resurfaced in a very real way. Several U.S. states have passed laws recognizing gold and silver as legal tender once again. Florida became one of the most recent states to do so, joining others that have taken similar steps. These laws do not replace the U.S. dollar. Instead, they allow gold and silver to be used and recognized as valid forms of payment within those states, giving residents an additional option. This return to constitutional principles has caught the attention of financial commentators, lawmakers, and everyday citizens alike. Supporters argue that these laws simply restore what the founders originally intended when they wrote the Constitution. Critics, on the other hand, point out that daily life and modern banking systems are built almost entirely around the dollar, making practical use of gold and silver coins more limited. Whatever position someone may hold, the historical pattern remains clear. The Constitution's original monetary framework was built to protect Americans from the very problems the continental currency crisis created. Understanding this history helps explain why some states, and some citizens, are once again turning their attention toward gold and silver in 2026. The decision to move away from the gold standard in 1971 did not just change financial policy. It changed the everyday reality of how Americans save, spend, and plan for their futures. To understand why this matters, it helps to look at the consequences from several different angles, including economic, social, and generational effects. From an economic standpoint, the most immediate consequence has been the steady decline in the dollar's purchasing power. When money is backed by a physical asset like gold, there's a natural limit on how much of it can be created. But once the dollar became a fiat currency, that limit disappeared. Over time, this has made it easier for the money supply to expand, which many economists link directly to long-term inflation. For families, this means that saving cash alone often does not preserve wealth the way it once did. A dollar saved decades ago simply does not stretch as far today. This economic shift also affects different generations in different ways. Older Americans, who may have grown up during a time when the dollar held more stable value, have often watched retirement savings and fixed incomes struggle to keep pace with rising costs. Younger generations face a different challenge. Many are entering adulthood already dealing with higher prices for homes, education, and everyday goods, making it harder to build savings from the ground up. Both groups are affected by the same root cause, even though the experience looks different depending on age and circumstance. Socially, this financial reality has contributed to growing conversations about trust. Trust in currency is not just an economic issue. It is deeply tied to how people feel about the stability of their government and financial institutions. When people see their money losing value year after year, it can create frustration and uncertainty, even if they do not fully understand the technical reasons behind it. This is part of why interest in alternative assets, including gold and silver, tends to rise during periods of economic uncertainty. From a political perspective, the return of state-level laws recognizing gold and silver as legal tender reflects a broader debate about the role of government in monetary policy. Supporters of these laws argue that giving citizens more options protects individual financial freedom, especially during times of high inflation or economic instability. They see it as a return to constitutional principles that were designed specifically to protect people from currency devaluation. Critics, however, raise practical concerns. They point out that modern commerce is built around digital transactions and centralized banking systems, meaning that using physical gold and silver in daily life is far more complicated than using a debit card or bank transfer. There are also broader implications for financial education. Many Americans today have grown up entirely within a fiat currency system, without direct experience of how a gold-backed system historically functioned. This makes conversations about monetary history, like the story of the pine tree shilling or the continental currency crisis, especially valuable. Understanding this history is not just an academic exercise. It helps people make more informed choices about how they save, invest, and plan for long-term financial security. It is important to present this topic in a balanced way. Gold and silver are not without their own risks, prices can fluctuate, and physical assets require secure storage and careful handling. At the same time, historical data shows that gold and silver have generally preserved value over very long periods of time, even through economic downturns and periods of high inflation. This is very different from paper currency, which relies entirely on continued public trust and government stability to hold its value. Taken together, these consequences show that monetary policy is never just a technical or historical topic. It shapes real lives, real families, and real financial decisions every single day. The choices made by the founding generation and the choices made in 1971 continue to influence how Americans experience money in 2026. As this story comes to a close, it leaves behind an important question for every viewer to consider. What does financial independence actually mean in 2026? For the founding generation, independence meant breaking away from a distant government that controlled their money, their trade, and their daily lives. Today, that question looks different, but it is still worth asking. Does true financial independence simply mean having a steady paycheck? Or does it also mean understanding how to protect the value of what has already been earned and saved? Looking ahead, several developments are worth watching closely. More states may continue to consider legislation recognizing gold and silver as legal tender, following the example set by Florida and others. These decisions are often debated in state legislatures, and residents interested in this topic may want to follow local news coverage or official government announcements to see whether similar proposals arise in their own states. At the national level, discussions about inflation, the Federal Reserve's policies, and the long-term value of the dollar continue to shape economic headlines. Staying informed about these topics does not require financial expertise. It simply requires paying attention to credible, verified sources over time. For viewers who want to explore this topic further, there are simple steps that can help. Reading historical documents, such as the U.S. Constitution and early Mint Act records, can provide valuable context directly from original sources. Following updates from official government financial agencies, such as the U.S. Department of the Treasury, can help viewers stay current on monetary policy changes. And for those interested in commemorative coins, the United States Mint regularly releases historical and anniversary coin collections, including special releases tied to major milestones like this year's 250th anniversary of American independence. Speaking of that milestone, 2026 carries special significance. It marks 250 years since the Declaration of Independence was signed, making it a meaningful moment to reflect not only on political freedom, but on the deeper lessons learned along the way, including the lessons about money and trust. It is worth remembering that both Thomas Jefferson and John Adams, two key figures behind the Declaration, passed away on the same day, July 4th, exactly 50 years after independence was declared in 1826. Their story remains one of the most remarkable coincidences in American history, and it adds a quiet, powerful weight to this holiday every single year. As viewers reflect on this story, Golden Crest Finance invites everyone watching to share their own thoughts in the comments. What does financial freedom mean to you personally? Do you believe historical lessons about money still apply today, or has the modern financial system moved too far beyond them? Every perspective adds value to this ongoing conversation, and hearing from viewers across different backgrounds and locations makes these discussions richer and more meaningful. Looking forward, one thing remains certain. Conversations about money, freedom, and trust are not new. They have shaped American history since long before 1776, and they will likely continue shaping conversations for generations to come. Whether someone chooses to explore gold and silver, study historical monetary policy, or simply become more mindful of how money works, staying informed is always a valuable step toward greater financial confidence. As fireworks light up the sky this Independence Day, they represent more than just celebration. They represent 250 years of a nation still learning, still questioning, and still working to protect the freedoms its founders first imagined, including the freedom to hold something of real, lasting value. Thank you for spending this time with Golden Crest Finance today. If this story added value to your Independence Day, consider subscribing and sharing it with someone who might appreciate this piece of history. Until next time, stay informed, stay curious, and enjoy a safe and happy 4th of July.